Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
So imagine you own like a really reliable dividend-paying utility stock.
Yeah.
The kind you buy because it's a bedrock asset.
Right, a total cornerstone for a retirement portfolio or just a steady income stream?
Exactly. You expect steady, maybe even slightly boring returns. But then you watch its value drop 40% in a single year. And to top it all off, its leadership slashes the dividend by more than half.
I mean, that is the ultimate nightmare for an income-focused investor. You wake up and you're suddenly holding a completely different financial instrument than the one you thought you bought.
And that is exactly the reality for shareholders of TELUS Corporation, stock symbol TU, right now.
Yeah, it's been a rough ride.
It really has. So today we are unpacking how a seemingly bulletproof telecom giant accidentally built, well, kind of a house of cards. We're using a really fresh research report from Compasscope alongside the, frankly, very eventful Q2 2026 earnings call transcript.
Eventful is definitely one word for it.
Right. Our mission for this deep dive is to explore how TELUS built this really unique business model, why that strategy is currently under fire from competitors and regulators, and the massive risks they're facing right now. Plus, we'll look at how their brand new CEO is attempting to right the ship.
And to really grasp how a telecom company finds itself in this specific situation, you kind of have to break down what TELUS actually does, because, I mean, it's not just a standard phone and internet provider anymore.
No, not at all. It's essentially a diversified communications and technology conglomerate now.
Right. So if you want to understand the current crisis, you have to look at the architecture of the business they've built over the last decade or so. It starts with the foundational layer, which they call TTech, or TELUS Technology Solutions.
Okay, so that's the telecom core, right?
Exactly.
Yeah.
You have your wireless services, mobile data, and their fixed wireline business, which is heavily driven by their PureFibre network.
Got it.
We are talking about the physical, unglamorous reality of telecom here. Laying thousands of miles of fiber optic cables directly to millions of homes, putting up cell towers. I mean, it requires massive upfront capital.
Which is the traditional business model. You spend billions digging up the ground, and then you just collect recurring subscription fees for the next 50 years.
Yeah, that was the original playbook.
Yeah.
But then TELUS layered on this massive plus strategy, which sits on top of that foundational network. They call it their global platforms.
And this is where the Compasscope report highlights that TELUS diverges completely from a lot of its telecom peers.
Totally. For instance, you have TELUS Digital. Historically, this handled customer experience management, so think massive outsourced contact centers around the world. But recently, they've been heavily pushing into CXAI, which is AI-enabled customer service, as well as data labeling for machine learning models.
Though the Compasscope report does point out that their legacy digital services like manual content moderation for big tech platforms, those are rapidly declining.
Right, which is a structural shift we definitely have to dig into in a minute.
Yeah.
Because it's huge. But then, alongside digital, they built TELUS Health. And this isn't just some small side project.
No, it's massive.
They manage electronic medical records for physicians, they operate virtual care platforms, and they run these huge employee wellness programs globally, which they really bolstered by acquiring a company called Workplace Options.
Wow, okay. And if healthcare wasn't diverse enough for a telecom company, they also have TELUS Agriculture and Consumer Goods, right?
Yeah, providing supply chain tracking and data analytics for animal agriculture.
Okay, let's just unpack this for a second. It sounds like they're using their telecom network as a paved highway. And instead of just charging tolls for the cars driving on it, they are building the hospitals, the farms, and the data centers sitting on the exits.
That is a great way to look at it. And extending that highway analogy, they are now building the actual destinations. Like, they're actively pushing into sovereign, sustainable, AI-focused data centers in Canada, specifically in places like Rimouski and Kenwood.
Sovereign meaning keeping the data inside the country.
Exactly. They don't just want to provide the bandwidth for the AI traffic. They want to own the physical buildings housing the incredibly complex AI brains that the traffic is communicating with.
Which is incredibly ambitious. But I mean, since TELUS is building this massive ecosystem on the exits, who are they actually fighting on that highway? Like, do they have an edge? Because looking at a 40% stock drop over the last year, whatever edge they had seems a bit blunt right now.
Well, in the Canadian telecom space, TELUS historically enjoyed what economists call efficient scale. Telecom is a highly concentrated market with massive barriers to entry.
Right, you can't just start a cell phone company in your garage.
Exactly. You need billions of dollars in government spectrum licenses. So TELUS built a superior, mostly completed fiber footprint, particularly out in Western Canada.
The PureFibre network we mentioned earlier?
Yes. And they combined that physical infrastructure with a premium brand known for very strong customer service. The strategy was to offer integrated wireline and wireless bundles. So if your home internet, your cell phone, and your smart home security are all on one TELUS bill, you are much less likely to leave for a competitor.
It makes the customers very sticky.
Extremely sticky. That ecosystem was a major competitive advantage.
But the Compascope report outlines a pretty heavy siege on that moat right now. And the biggest battering ram seems to be regulatory risk. Specifically, the CRTC, Canada's telecom regulator, has instituted mandates forcing incumbent networks to offer wholesale access.
Yeah, and the mechanics of wholesale access fundamentally alter the economics of telecom. The government regulator basically steps in and dictates that companies like TELUS, who spent the billions laying the physical fiber and building the towers,
Right.
they must rent out space on those networks to competitors at a regulated, discounted rate.
Okay, here's where I have to push back a bit on this whole idea of efficient scale being an advantage. If a company like Quebecor gets to rent the incumbents' networks through 2029 at wholesale rates set by the government, doesn't that completely bypass the multi-billion-dollar moat TELUS just spent years digging?
Oh, it absolutely blows a hole in the moat. And that is exactly why the market is so spooked right now. Through their Videotron and Freedom Mobile brands, Quebecor has emerged as a fierce, price-cutting, fourth national competitor.
So they just get to skip the hard part.
Pretty much. They get to come in, avoid that massive upfront capital expenditure of laying their own national network, and compete purely on price using the wholesale mandate.
Wow.
It forces TELUS into a brutal corner. They either match Quebecor's low prices, which destroys the premium revenue model they built their debt around.
Or they hold the line on price and risk leading market share.
Exactly. And to make matters worse, TELUS has this unique vulnerability right now where their non-telecom platforms, specifically digital and health, are currently dragging down their overall profitability instead of acting as a buffer against this telecom price war.
So the diversified platforms that were supposed to be their unique differentiator are currently acting like an anchor in a storm.
Basically, yeah.
Man. So with Quebecor undercutting prices and regulators forcing the gates open, how does TELUS actually plan to grow this massive conglomerate?
Well, the growth strategy is undergoing a harsh reality check. In the core telecom business, they're no longer chasing massive subscriber volume. They're guiding for modest growth, about 200,000 net new additions per year.
Which really aligns with the demographic realities the Compascope report highlights. Canada is currently shifting into a lower immigration environment compared to recent years, meaning the pool of totally new subscribers entering the country is just shrinking.
Right. When the overall pie stops growing rapidly, you have to focus on the quality of your slice. So their strategy is to preserve premium economics and focus intensely on ARPU, average revenue per user.
Oh.
They want to bundle more services to their existing loyal customers rather than get into a race to the bottom on price with Freedom Mobile just to acquire low-value subscribers who might jump ship next year anyway.
So telecom is shifting to defense and value extraction. What about the growth strategy for those global platforms?
In digital, it's a somewhat desperate pivot. They are trying to transition away from those declining legacy services like the basic content moderation and move up the value chain toward complex CXAI and robotics data solutions.
Gotcha.
But honestly, the most critical part of their growth strategy right now isn't about products or subscribers at all. It's strictly financial.
Yeah, this is where the Q2 earnings call gets really intense. Their overarching goal is to achieve a minimum 10% compounded annual free cash flow growth in 2027 and 2028. And they have a strict deleveraging target to get their net debt to EBITDA ratio down to 3.0x or lower by the end of 2028.
We really need to break down why those specific financial mechanics matter, because a telecom company obsessing over debt ratios and free cash flow targets instead of cell phone subscribers is a huge red flag for the balance sheet.
For sure.
They are currently sitting at a 3.5x leverage ratio. EBITDA is essentially the cash profit the business generates from its operations. So a 3.5x ratio means their total debt is 3.5 times the cash they generate in an entire year.
Right. So to put that in everyday terms for you listening, it's like a family taking home $100,000 a year but carrying a $350,000 credit card balance.
That's a great analogy.
And Just like a family dealing with rising interest rates over the last few years, the carrying cost of that massive debt is suddenly eating up all the cash that used to go toward paying dividends or, funding new projects. They need to get that balance down to $300,000 just to breathe.
Exactly. They are heavily levered because they spent billions building that PureFibre network and acquiring these platform businesses back when money was cheap. Now the bill is due, borrowing costs are significantly higher, and the market is heavily penalizing them for the exposure.
So that ambitious growth strategy and debt reduction plan brings us to the massive execution risks the company is currently juggling. To pull off this financial surgery, they brought in a brand new CEO, Victor Dodig.
Yeah, Dodig officially took over on July 1st, 2026.
Yeah.
His background is very telling here. He isn't a lifelong telecom engineer. He was the CEO of CIBC, a major Canadian bank, for 11 years.
Oh, wow. Okay.
So he is a financial and operational restructuring expert, and he's partnered with the new CFO, Gopi Chande, to execute this turnaround.
Together, they are attempting a massive organizational restructuring and a surgical cost-cutting program. But here's the catch. They have to do this without hurting the premium customer service that TELUS relies on to justify its higher prices.
Right, because when you mandate deep cost cuts, frontline customer service is typically the first casualty. If hold times go up and network reliability drops, the premium brand deteriorates.
And customers will just switch to Quebecor for the cheaper price.
Exactly. It's a very delicate balancing act. But that's just the core telecom execution risk. They also have the digital turnaround.
Yeah, they have to pivot TELUS Digital to AI services fast enough to outrun the collapse of their legacy services. Because their big tech clients are automating that legacy work, like manual content moderation, using their own artificial intelligence.
It's crazy.
It's like trying to change the engine on an airplane while it's in a nosedive.
It really is the bitter irony of the AI boom for service providers. The technology TELUS wants to hell is the exact same technology making their legacy business obsolete. And to add to the complexity, Dodig announced a moratorium on acquisitions. They are strictly in sell mode. They need to successfully monetize non-core assets, potentially selling off real estate or parts of TELUS Health, just to hit that critical 3.0x leverage target.
But wait, here's where the strategy seems fundamentally contradictory to me. They want to drastically cut costs, sell off assets, and pay down debt. But simultaneously, they want to build state-of-the-art sovereign AI data centers. Like, how do you aggressively build the infrastructure of the future while you are actively gutting the budget to pay for the past?
I mean, it's the core tension of their entire strategy. Dodig claims they can thread this needle by finding external capital partners to fund the actual physical buildings and cooling systems of the data centers.
Also bringing in outside money.
Right, allowing TELUS to focus its own capital purely on the higher margin AI services running inside them. But the execution risk there is astronomical. If they misjudge demand, or if global hyperscalers like Amazon or Microsoft beat them to the punch in Canada, they are stuck with incredibly expensive, underutilized infrastructure.
And these execution risks aren't just theoretical, right? They are the exact reason the stock has dramatically underperformed its peers over the last year. Let's look at the divergence between TELUS and its main rivals, BCE and Rogers.
Yeah, if you rewind to mid-2020 through mid-2025, TELUS was actually outperforming both of them. They got their fiber network built early, meaning they had passed their peak capital expenditure phase, and investors were really buying into the diversified growth story of their digital and health platforms.
The stock traded at a premium.
It did.
But then, since mid-2025, the stock fell roughly 40%. The Composcope report outlines exactly why the narrative flipped. First, the digital business wasn't growing as expected, leading to unit impairments. Second, they paused their dividend growth, which shocked investors who relied on a historical 3 to 8% annual bump.
Which is huge for utility investors.
Huge. And third, that 3.5x leverage ratio collided violently with a high interest rate environment.
Meanwhile, while TELUS was struggling to hold its conglomerate together, its peers took decisive action. BCE ripped the Band-Aid off earlier with a massive 56% dividend cut back in May 2025 to clean up its own balance sheet.
They took their medicine early.
Exactly. Rogers, meanwhile, was showing clear operational synergies from its massive acquisition of Shaw.
So investors who wanted yield and a clean deleveraging story simply rotated their money away from TELUS and into Rogers and BCE, because TELUS is stubbornly holding on to this Telecom plus platforms approach, while BCE and Rogers have retreated to being pure-play connectivity companies.
And the market is currently punishing TELUS for that complexity. The Compasscope report features a really insightful synergy scorecard that evaluates whether these diverse platforms actually provide any tangible benefit to the core telecom business.
Yeah, I found this scorecard fascinating. According to the report, TELUS Health actually works. There is deep synergy there. If TELUS sells a corporate 5G mobile plan to a business and bundles in virtual healthcare and wellness programs for the employees, they can charge a higher ARPU, and that business is significantly less likely to ever cancel their phone plan.
It makes the core telecom product structurally stickier. The platform actively reinforces the moat. But then you evaluate TELUS Digital on that same scorecard.
Right. It makes perfect sense that offering free virtual doctor visits keeps a business from canceling their mobile plan. But running content moderation for big tech companies halfway around the world, that has zero to do with this cell tower in Vancouver.
The market recognizes that disconnect completely. TELUS Digital acts as a completely isolated add-on. Compasscope actually notes that only about 6% of its revenue comes from intersegment work.
Wow, only 6%.
Yeah. It fails to justify its financial drag on the core business because it simply doesn't make the telecom network any more valuable or sticky to the average Canadian consumer.
Which brings us to the actual mechanics of the Q2 2026 earnings.
Yeah.
Call Victor Doherty's very first as CEO. With massive debt, plummeting platform revenues, and fierce competition, something had to give. And on Dodig's first day, the dam finally broke.
It was a brutal clearing of the decks. The most staggering number released was a massive $2.1 billion impairment charge on TELUS Digital.
Just to clarify how an impairment charge works for you listening, they didn't write a check for $2.1 billion yesterday.
Yeah.
It's an accounting mechanism where leadership officially admits that an asset they bought or built is permanently worth billions less than what they were carrying it for on their balance sheet.
Right. It destroys shareholder equity overnight. It is management's formal acknowledgement that clients are automating those legacy digital services so rapidly that the future cash flows they modeled, they simply do not exist anymore.
And immediately following that write-down came the dividend shock. Effective October 1st, they slashed the quarterly dividend by 55%, down to 18.75 cents a share. I mean, for a company whose investors specifically bought in for the reliable utility-like dividend, cutting it by 55% on your first day as CEO is like walking into a party and unplaying the music. It's completely jarring, but based on that credit card math we did earlier, probably necessary.
Yeah, Dodig noted that this cut will save the company $2.7 billion cumulatively through the end of 2028. And every single cent of that retained cash is earmarked directly for paying down debt to hit that 3.0x leverage target.
Alongside the dividend cut, they had to revise their guidance downward. They originally projected EBITDA growth for the year, and now they're forecasting a 2% to 4% decline for 2026.
But the wild part is, despite acknowledging that their cash profit is shrinking, their capital expenditure actually went up slightly to $2.6 billion for the year.
Yeah, several analysts on the call questioned that discrepancy. CFO Gopi Chande explained it's driven by two factors: inflation on physical network equipment and a deliberate strategic investment into those sovereign AI data centers. They are betting that a short-term bump in capital spending now will secure a long-term foothold in domestic AI infrastructure.
It's a huge bet. But amid all this financial chaos and restructuring, there was one major silver lining in the Q2 report. The core telecom business is remarkably stable. Mobile network revenue was up 1%, marking their third consecutive quarter of growth.
Nice.
And their postpaid churn, which is the rate at which people actually cancel their monthly phone plans, is holding at an industry-leading 0.97%.
Wow. A churn rate under 1% is an astonishing achievement in modern telecom, especially considering the aggressive government-mandated wholesale pricing from Quebec, where we talked about. It proves that despite the massive financial turmoil at the corporate level, the actual physical network quality and the frontline customer service are still incredibly resilient. People are staying with TELUS.
Exactly. The foundation is still solid.
So what does this all mean for the future of the company? Now that the dividend music has stopped and the financial surgery has really begun, what should you be watching for next to see if this turnaround is actually working?
The absolute most critical metric is the deleveraging pace. You need to watch the upcoming quarterly earnings to see if they are actually generating the free cash flow from operations and successfully monetizing those non-core assets to visibly move that net debt to EBITDA ratio down toward that 3.0x target.
Right.
If that ratio stalls out at 3.5x despite the dividend cut, the market will lose whatever faith is left.
You also need to keep an eye on TELUS Digital's trajectory.
Right.
Will this desperate pivot towards CXAI and data labeling actually replace the bleeding legacy revenues, or will TELUS Digital remain a financial anchor dragging down the whole ship while they try to fix the balance sheet?
Yeah, and the macro environment is equally important. Will the CRTC decide to expand those wholesale access mandates to fiber networks everywhere? Because that would permanently cap their wireline pricing power. And how will Canada's lower immigration numbers fundamentally alter the ceiling for long-term wireless subscriber growth?
And lastly, those AI data centers. Will the demand for sovereign Canadian AI infrastructure actually materialize and justify the heavy capital investment they are making right now, or will global hyperscalers just swoop in and render the investment obsolete?
It feels like we are watching a massive ship try to thread a very narrow needle in a hurricane. Every single quarter is going to be a severe test of Victor Dodig's promise of operational discipline.
It really requires flawless execution across multiple fronts. I mean, they have to shrink their debt, execute surgical cost cuts, pivot a collapsing digital business, and build cutting-edge AI infrastructure, all while fighting off discount competitors in their foundational market. To recap, we've tracked TELUS's journey from a high-flying, diversified telecom darling that commanded a market premium to a company currently executing a painful, back-to-basics financial surgery just to save its balance sheet. They are paring back the ambition to focus intensely on free cash flow and debt reduction.
The 55% dividend cut hurts income investors deeply today, but the long-term thesis management is pitching is that a leaner, significantly less leveraged TELUS will emerge stronger, anchored by that incredible 0.97% churn rate.
But let me leave you with a final thought to ponder that goes beyond the current balance sheet woes. As TELUS pushes hard and spends heavily into these sovereign AI data centers, could future national security regulations actually force Canadian governments, hospitals, and financial institutions to exclusively use domestic providers for their AI workloads?
Oh, that's an interesting angle.
Right. If so, this current financial headache might accidentally position TELUS with an impenetrable, government-mandated monopoly over Canada's future AI infrastructure. That reliable utility stock might look a little battered right now, but maybe, just maybe, it's building an absolute fortress for tomorrow.
A fascinating possibility that could completely rewrite their valuation in the next decade.
Thanks for joining us on this deep dive.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.